Welcome. Subscribe to AS Foundation, India's leading academy for CA course, and hit the bell icon to get the latest updates. Thank you.
Good morning. Please come to commercial banking versus investment banking. So commercial banking is what you have been learning in your life till now. Even you go for audit also in the month of April, bank audit. Have you done? That is commercial bank. State Bank of India, ICICI Bank, Axis Bank, yes, JP Morgan, investment banking, Morgan Stanley, investment banking. So, what is the difference in the working of banking and commercial banking and investment banking? A good comparison, because they are very different. Although overall the intention is same, to raise funds and give it to other party. But in case of banks, they take deposits from large number of investors and they give loan to the needy person. But then there is a one-to-one relationship between the bank and the borrower. Bank does not have to issue prospectus, red herring prospectus, go to SEBI, go to state stock exchange, nothing. They will simply identify a good borrower, lend him. Whereas investment banking companies, they raise funds by public issues. So they have to comply a lot of regulations, and then the funds raised are handed over to the corporates. And normally it is in the form of shares and bonds, debentures. So on one level, if you see, they are doing the similar activity, raising of funds and helping those who need funds. But the way they do this entire activities is different. Commercial and investment banking share many aspects, but they have some fundamental differences also. Commercial banker may take deposits for current and saving account from customer. So they allow you to open current account, they allow you to open the saving account, and from that you can withdraw your money whenever you want. Can investment banking also do the same thing? No, they are not allowed to open current and saving account. Then commercial banks in India must follow a long list of regulations. RBI Act, Banking Regulation Act, Companies Act, okay. Then Basel, SARFAESI, Insolvency Code. All these regulations they have to follow. If they are listed company, then stock exchange regulation, SEBI regulations they have to follow. So in India they have to follow long list of regulations. The idea is to protect the interest of the customer, depositors and different stakeholders. The typical commercial banking is generally straightforward. In commercial banks, usually what happens, there are depositors who deposit their money, and then there are borrowers who borrow money from the banks. So this is how typically a commercial banks operate. People like you who want to buy a house can go to a commercial bank. You want to buy a car after you become CA, but you want to buy which one? Audi? Huh? Not Audi. Then Jaguar. Jaguar. My goodness. See, the CA final status students desire directly Jaguar after qualifying, or finance an addition to your home. You already have one home, you want to add one more, so you can borrow money from the commercial bank. Companies borrow to finance the growth of their company to meet the immediate cash needs. General thing. Individuals borrow for house, car, addition to house. Companies borrow to finance their business growth. Companies that borrow from commercial bank can range in size from a dry cleaner on the corner to a multinational conglomerate. So everybody approaches the commercial bank to raise money, irrespective of who that person is. So it can be a small enterprise, it can be an MNC also. Now we are understanding the difference between commercial banking and investment banking. In commercial banking, what happens? You and bank enter into a contract where bank directly give you loan. In investment banking, it will not happen. Investment banker will raise money from the public on behalf of the company. So there is no private contract between investment banking and the issuing company as far as funds are concerned. They only act as intermediary, whereas bank directly give you the loan. So loan from commercial banks are structured as private legally binding contract between the two parties. So in case of bank, the loan is between bank and you. Banks work with their clients to individually determine the terms of the loan. So when you go to the bank, you submit your project report, bank will decide how much loan to be given to you, how much is the time period, how much is the interest to be charged. So it's one-to-one negotiation between you and the bank. And then your individual credit history, that is your risk profile, determines the amount you can borrow and how much interest you are charged. So this is a pure negotiation between you and the bank. Loan amount, loan period, interest rate. Commercial bank collects funds and loan them to its customer for taking advantage of large spread between their cost of fund, which is say 1%, and return on their funds loaned, which is say 5 to 14%. These are all indicative figures only. It means suppose on one hand we have a depositor. This is a depositor. He deposits in a commercial bank. And on the other hand, there is a borrower. So what is the business model of commercial banks? You know, to the depositor it will pay 4%, 5%, 6%. Average is around 4-5% because in current account there is no interest. In saving account there is very low interest. So their cost of fund is, it is written 1%, but let us say it is 4-5%. And to the borrower, they charge 14% interest, 12% interest. On housing loan, they charge 9 to 10% interest. On overdraft, they charge 20% interest also. See the spread. That is their business model. Make profit because of the spread. An investment bank does not have an inventory of cash deposit. They don't have public deposit, just like commercial banks have. They only act as an intermediary and matches the seller of the stock and bond with the buyers of the stock and bond. So what is the function of the investment bank? On one hand, you are suppose investors, and other hand there is a corporate. So they will help the two. Okay, they will help them. It is not raising money and lending to corporate. It is only facilitating the process whereby investors, small and big, can invest in the stocks and bonds of the corporate. So they are only facilitators. Whereas in case of bank, the bank directly borrows money from the depositor and commercial bank directly lends to the individual and corporates. So that is the difference. Companies use investment bank toward the same end as they use the commercial bank. Purpose is same, raising of funds. But in case of commercial bank, you directly borrow from the commercial bank. In case of investment bank, you take their help in raising of funds from the public. If a company needs capital, it may get a loan from the bank, or it may ask an investment bank to sell equity or debt. In both cases, company is able to raise the funds. Because commercial banks already have funds available from their depositors, an investment bank does not have, an I bank must spend considerable time finding investors in order to obtain capital for its client. So this is one, you can say, small disadvantage. In case of bank, you don't have to deal with a large number of investors. Okay, but in case of investment banking, they will have to first ensure that there are number of investors who are willing to invest. They will create a demand for your security, and then they will come out with the public issue. So it's a long time taking process. Whereas in case of banks, you can directly approach the bank. But again, in case of bank, the bank will lend you only up to a certain amount of funds. 5,000 crore, 400 crore. If you want to raise 40,000 crore, 1 lakh crore, will a bank in India give you a loan of 1 lakh crore? 40,000 crore? Do you think? I have a doubt. They will not give you so much of loan to a single entity. But yes, you can come out with an IPO and raise around 20-30,000 crore rupees. Okay. So investment bank typically sell public securities as opposed to private loan agreement. Question is, what is the difference between commercial bank and investment bank? So investment bank raise money by selling security to the public, whereas commercial bank give a loan to the borrower and enter into a loan agreement with the borrower. Technically, securities such as Microsoft stock or Tata Steel AAA bond represent a high degree of safety and are traded either on a public exchange or through an approved dealer. And who is the dealer? The dealer is an investment bank. Now suppose there is a company ITC. As you know, ITC is a FMCG corporate, large company in FMCG business, and it wants to raise, for example, 20 million, which is a very small amount for them. So let us assume they want to raise 20 million. What will they do? It has two choices. Option one, they will go to a commercial bank like State Bank of India, put their proposal, SBI will give them a loan, pay interest, repay the loan. Simple. There is another option also. It can sell the bonds publicly using an investment bank. Why they will do it? Because SBI will charge a high rate of interest, say 14%, and to the depositor they are paying 5, 6, 7%. Instead of that, why not we issue debenture and bonds to public directly, give them 12% interest or 9% interest, so they get 2 or 3% more. We pay 3 or 4% less, and minus 1 or 2% suppose commission that you have to pay to this investment banking. Still you save lot of money. So it could sell bonds publicly using an investment bank such as Merrill Lynch. Merrill Lynch is the name of the investment banking company, very big company. The rupees 20 million bond issue raised by Merrill would be broken into many bonds and then sold to the public. So the difference between a loan and a bond is that in a loan you have only one party giving you 20 million. Bonds and debenture, you divide that 20 million into small pieces first. Say 100 rupees per bond, 1000 rupees per bond, and then each according to his ability can subscribe. For example, the issue could be broken into 20,000 bonds of rupees 1000 each. What is the advantage of breaking into small pieces? So that even small investors who wants to invest say 10,000 rupees, 15,000 rupees, even they can participate. Once sold, the company receives 20 million, an investor receives total bond. Over the time, the investors in the bond offering receive coupon payment, which you call interest, and ultimately the principal amount at the end of the life of the loan is paid when ITC buys back the bonds. Thus we see that in a bond offering, while the money is still loaned to ITC, It is actually loaned by numerous investors rather than a single bank. So there are advantage and disadvantage, because now the administrative cost goes up in serving these bondholders. Yes or no? So there are 10,000 suppose bondholders, so you have to maintain records of 10,000 bondholders. Some of them may want certificate in physical form, so you have to send them. Some of them may want interest warrant rather than ECS facility, so you have to pay interest warrant separately. So little bit cost increases, but one has to, again, you are a CA candidate, you should know what is cost benefit analysis, and accordingly either take a bank loan or issue the debentures. That is why companies go for a debenture issue, because they are able to save interest. Okay. Next is, as the investment bank involved in the offering does not own the bonds, but merely place them with investor at the outset, it earns no interest. What is the income of the investment banker? It does not earn interest on that, but it will earn some fees or commission. Interest is earned by the bondholder. Whereas in case of a commercial bank, the bank itself earns the interest. Investment bank makes money by charging the client a small percentage of the transaction on its completion. That small percentage also in absolute terms is a big amount. Like they will help you to raise bonds of say 5,000 crore rupees. And if they charge 1% also, it is 50 crore rupees. Is it right? Recently they helped some company in raising 12,000 crore rupees. Suppose they charge 1% of that. That is 120 crore rupees fees they have charged. Okay. So investment bank call this upfront fee the underwriting discount. So underline underwriting discount. What is underwriting discount? The fees that investment bankers charge. In contrast, a commercial banks making a loan actually receive the interest and simultaneously owns the debt also. So they receive the interest, they are the owner of the security, they will get the repayment of principal also. Do they also get commission? No, commercial bank don't get commission, but some of them are smart. They charge you processing fees, documentation fees, and some other fees they charge, okay, which is their income. So now a small summary they have prepared. Differences between investment bank and a commercial bank. They can ask you a theory question also here for 4 marks. Write a note on differences between investment bank and commercial bank. So 4 points I have written. Investment bank help their client in raising capital by acting as an intermediary between the buyer and seller of the security. Commercial banks are engaged in business of accepting deposit from customer and lending money to individuals and corporates. Very simple difference. You will be able to write. Do not take deposit from customers. They are not allowed. Can legally take deposit from customer, commercial bank. 3. Do not own the security. Investment bank do not own the security. They only act as intermediary for smooth transaction of buying and selling the securities. Commercial banks own the loan granted to their customer. So in their books it will appear loan to customer as an asset. But in investment banker's book, investment in bonds will not appear. Investment bank earn in the form of commission, fees, whereas commercial banks earn in the form of interest on the loan. Okay, now paragraph 2, very important now. Functions of an investment bank. What do they do? So there are so many functions we have mentioned here. First is issue of IPO. They are the specialist, okay, because they have got all the technicalities known to them. If you have to come out with an IPO, that is whom you have to approach, what legal compliances you have to do, what are the documents you have to submit, how do you draft different types of offer documents called prospectus, red herring prospectus, how do you value your IPO, then how do you actually market your IPO to the whole network of investors. So they have got all the specialization in that. So investment banks underwrite stock offering just as they do the bond offering. That is their specialization. In the stock offering process, companies sell a portion of the equity or ownership of itself to the investing public. It means company wants to dilute the stake. They want to offer the shares to the public, means existing promoter stake is going to get diluted. When the company is raising funds for the first time from the public, it is called IPO. And through the IPO, the company is able to sell its stock, shares, debentures, bonds to the public in general. And after the IPO, the stock is listed and traded on a recognized stock exchange like BSE or NSE. Looks simple, but the whole procedural formalities are complicated. So bankers of one of the largest IPOs in the Indian history, rupees 12,000 crore IPO of Coal India Limited included. So you know, some years ago, Coal India Limited had come out with an IPO because government wanted to list it. Okay, it's a government company. Still, government has a lot of stake in that company. But then they wanted to dilute their stake and raise money. 12,000 crore at that time was a big number. Some years ago. And how many investment bankers they had appointed? CT Group, DSP Merrill Lynch, Morgan Stanley, Deutsche Bank, Inam Financial, Kotak Mahindra Capital Company. 6 or 7, 1, 2, 3, 4, 5, 6. Two names are mentioned here. So 6 people that employed, 6 investment banking companies. The equity underwriting process is another major way in which investment banking differs from commercial bank. So this also you can include in the difference. This investment bankers act as an underwriter in case of equity issue. Investment bankers act as an underwriter in equity issues. Whereas commercial banks normally do not underwrite an equity issue. Commercial banks were able to legally underwrite debt. Earlier they were allowed. Now also I think they can underwrite debt. And some of the largest commercial banks have developed substantial expertise in underwriting public bond deals. So they can underwrite bonds, but commercial banks usually are not involved in underwriting of equity. So not only do these banks make loan utilizing their deposit, they also underwrite bonds through a corporate finance department. So they have a separate department, corporate finance in banking sector also. And through that they can purchase the bonds, because one of the businesses of banks is to invest in bonds to meet their SLR requirement or to be on a safer side. Okay. But normally they are not allowed to invest too much in equity shares. They can't take too much exposure in the equity shares. When it comes to underwriting bond offering, commercial banks have long competed for this business directly with investment bank. With respect to bond offering, both are underwriters, but with respect to equity offering, usually commercial banks cannot act as underwriter. However, only the biggest tier of commercial bank is able to do so. And who does the bond underwriting? Again, only large companies like ICICI or SBI. Chotu banks will not be able to underwrite this bond issue also. Okay. So mostly because the size of the most public bond issue is large and competition for such deals is quite fierce. You should read Economics Times, Financial Express, where you will see companies are coming out with 5,000 crore rupees debenture issue. So therefore bigger banks participate, smaller banks do not, because they don't have so much of money power only, right? Now issue of IPO involves some steps. You want to come out with an IPO, suppose tomorrow, of your CA firm, not allowed, just example. We can in future is uncertain. So what are the steps involved? First you hire the manager, means first to decide who will be your investment bankers. It means first point is you decide the investment bankers. Because if you hire a good investment banker, manager means he will manage your entire IPO, not the usual manager in the office. Manager here means the IPO manager, the investment banker. There are so many, you have seen the list. Choose him correctly. Choose him. Why?
Because it is from an investment banking perspective.
No, first point is from the issuing company's point of view. Then the role of investment banking starts. Once you choose the manager, tell him that we want to go for IPO. Then the investment banker will start the due diligence and marketing. Marketing is also becoming important because you should make the investor aware that an IPO is coming. Create a buzz, okay, create a hype. Sometimes you can do advertisement on TV also, radio also, newspaper, hoarding, auto rickshaw, bus, T-shirt, okay, camps, seminar. Yes, some seminar is going on, you put your hoarding in that seminar, okay. You can organize rallies also, yes, marathon, 21 kilometer, give a T-shirt saying IPO, okay, don't give so many ideas.
Meeting with brokers.
So come to the point. First point is hiring the managers. Choose your investment banker carefully, because it is they who will make your IPO successful. It is who they will help you to get more subscription. They will give you better values, etc. Okay. Good investment banker will also bring reputation to your IPO. People normally see who is backing up this IPO. And if the investment banking is a reputed company, generally investor will have a confidence in that. The first step for company wishing to go public is to hire managers for its offering. So this is first is from company point of view. That is, you have to choose your investment banker. How will you choose? They have given some guideline. Check the past experience if you have any with that investment banker or any other company who has got some experience. Then you see the fees quoted by the investment banker. It should not be very expensive also. You are going to raise 100 crore and 10 crore rupees the fees. It's too much. Then the valuation the bank promises to fetch for the company's offering. How much money he will be able to raise, valuation. Because in case of stock offering, valuation is very critical. If you are supported by a good investment bank, you can get more money per share. Yes or no? There is no right formula for valuation of equity share. You have been told in SFM batch. Is there any formula which will say this is the only way you have to arrive at? There are different ways. You can manipulate the valuation of equity share this way or that way and you can raise the value. But again, who is promoting that issue makes a lot of difference. Is it right? So the selection process of investment banker, 3 points I have written. It relies upon the investment banker's general reputation, expertise, as well as on the quality of its research coverage in the company's specific industry. Okay. So you look at the reputation, integrity, expertise, research reports, how much is they have knowledge about the industry. Is it right? Look at their research reports, how deeply they go into the research. Then it also depends on whether the issuer would like to see its security held more by individuals or more by institutional investor. What kind of shareholders you want, individual or institutional? Now again it depends on investment bankers' distribution expertise. Some investment bankers may have expertise in institutional investor. They have more institutional investment client. Some may have expertise in individuals. What as a promoter I want? Do I want my shareholding to get concentrated in few institutional investor, or it should be spread across lakhs of individual investor? According to that you choose the investment banker. There are advantage, disadvantage. Institutional investors, they bring expertise, okay? They give ideas, they give you positive suggestions, they participate in the decision making process, but they are also interfering. Individual investors are non-interfering. I never go and ask Mukesh Ambani ji, why did you give Reliance Jio free of cost? I am just a 5 share, owning 5 share, not 5%, no, 5 share only. 5 shares only out of those millions and crores of shares they have issued, so that every year I will get one annual report free of cost, okay? And I do not interfere. I accept whatever dividend they will pay. I will not criticize their judgment or decisions. But then I do not contribute in the management or decision making process or debates, healthy discussion that I am not able to invest in. These are advantage, disadvantage. Then prior banking relationship. In case if you have a prior experience with that company, the issuer and the member of its boards, especially venture capitalists, have with specific firms in the investment banking community also influence the selection outcome. If you or your members have a prior dealing with that investment banker, it might influence your decision. Normally, we have a psychological issue here. If we deal with a certain set of people, next time also we would like to deal with the same set of people. Yes or no? Does your client change auditor every year? Same client is there in your office since last 20 years, 30 years. Yes or no? Because now he has got a comfort level there. Point number 3 says the same thing. If you board members have already dealt with an investment banking company, then you might like to continue with that. Hiring the manager is a two-way affair. What is a two-way affair? You want to go with a particular investment banker. Some investment bankers are also choosy. They also want to have a certain set of clients only. Is it right? So that is called two-way affair. Just like you want to ensure that you tie up with a good investment banker, many of this reputable investment banking company also wants to tie up with good clients also. That is the meaning of this line. So a reputable investment banker choosing its clients at least as carefully as the company should choose the investment banker. True or false? If this line is asked in the exam, true. Because it will affect their reputation also. If they help some company which turns out to be an unethical company, fraud company, scamster company, then in future people will not go to them. Their whole business model will collapse. Understood? Now next is lead or book running manager. Tick mark. There are in their IPO, as we saw in one Coal India case, there are multiple investment managers. Company does not want to take chance, okay? Or maybe the issue is so large that it may not be under the capability of one investment banker. So they had 2, 3, 4, 5. In one case, they went up to 6. One of them will be called lead manager or book running manager. Okay, so one of them will be like a captain. In a cricket match, everybody is equal. Do you know that? But somebody is made a captain so that some basic decision on the field he can take.
Originating house.
Originating house. The lead manager always appear on the left of the cover of the prospectus. So on the prospectus, the names are written of all the lead manager. The one who will appear on the leftmost side, you can assume, it's a convention, that he is the lead manager. And he plays the major role throughout the transaction. So most of the task that he has to do, task that has to be done is done by the lead manager. Then there is a note on the screen, the managing underwriter makes. What is the role of that lead manager, book running manager or managing underwriter? All the arrangement with the issuer. So you have to do all the formalities with the issuer, contact the issuer team, get all the information, get all the documents, get all the signatures, then establishes the schedule of the issue. What is the next thing? When will the issue be brought in? All the timelines he has to decide. When will I file the red herring prospectus with SEBI, with registrar, with public? All these things he has to decide. And then he has the primary responsibility for due diligence process, pricing and distribution of the stock. So that is lead managers do. Now we will discuss due diligence and drafting. Due diligence and drafting is very important, especially this due diligence. Due diligence means first understanding the company's business. They will meet the company's manager, they will visit the premise, they will visit the factories also if required, go through all your past balance sheet, P&L account, cash flow statement, notes to account, auditor's report. Okay. So this is called due diligence. They will also think about various possibilities. And then after they are convinced, they will file the legal documents required by the stock exchange. Some reputed managers, investment bankers, they are very careful because their names get associated with an IPO. So they can't afford any mistake or a failure. So they do due diligence. Some of them may refuse to go ahead with the particular issue also if they think something is wrong. Lawyers, accountants like you, bankers, and of course the management must toil for countless hours to complete the filing in a timely manner. What does lawyers do here? They have a team of lawyers also, or they will outsource the lawyers, okay? They may not have their own in-house lawyers. Sometimes they will just take the help of some reputed law firm who will ensure that all legal compliances are done. And then people like you, accountant, you have to ensure balance sheet, P&L account, cash flow, disclosures are as per the format of the law, not necessarily as per your Schedule 3 or India's format. They may want information in a certain legal format, which the accountants have to do. Then bankers, of course, they will all manage the show. And companies management also. What management is doing? They have to give information. No? So if you work in the big company and if you work in their finance department and it is coming out with an IPO, rest assured for the next few months you will not be able to sleep. Sleep in the office only. Take a bed in the office only and sleep whenever you get time. Folding bed, folding sofa set. Okay. Take your cloth also there. You may not come home maybe next day. Because yes, there are so many deadlines to be met, so much of data that you have to compile, and you have to ensure that the data is consistent, accurate, no mistake. The moment there is a mistake, then SEBI will stop the process further. Again, 30 days delay. Some investor will point out the mistake. Some analyst will point out the mistake. So they have to be very careful. And then you have to do a lot of color combination also so that it looks attractive. The prospectus becomes like a marketing document for them. Is it right? So there is a design team who drafts the prospectus also once you give the data. Securities Act also makes it illegal to offer or sell security to the public unless they have first been registered. Of course, first you have to register with SEBI, ROC, then you can offer. It is important to note that SEBI or SEC, what is SEC? Security Exchange Commission. Institute note only mentions about SEBI, sorry, SEC. I have added SEBI also. Has no authority to prevent a public offering based on the quality of the security involved. SEBI will not stop you from going for a public offering just because your financials may not be as good as it should be. Let the investor take the call. What is my duty as a regulator? That you are able to comply with all the regulation. Have you done? Yes. Are you giving all the disclosures that are required? Yes. Yes. Then go ahead. Then let the investor take the decision whether he wants to invest or not. And then once the registration statement is filed with SEBI or SEC, then it is transformed into preliminary prospectus, which in India we called red herring prospectus. It is not the final prospectus because it may not contain the issue price. It may not contain the issue price. Issue price will be known only after the book building route is complete. The preliminary prospectus is one of the primary tools in marketing the issue. We have discussed different types of prospectus in one previous chapter. So read that. Will not again invest time here. And then within 20 days in USA, the Security Exchange Commission has to reply within 20 days. Now you just check how many days SEBI requires. Is it still 20 or 30 days? That was there in that chapter. Capital market chapter. So I think it is 30 days, not unlimited. Now every government task has to be performed within a given time slot. Otherwise the officer will be punished. Some kind of punishment will be there. So SEBI, I think 30 days responds to the initial filing and declare the issue effective. If there is a mistake in that document, then they will ask you to make amendment. At this stage, the red herring is amended and transformed into a prospectus, which is the official offering document. This entire process which they have described here is applicable in USA. Just you can mention somewhere, because some process is slightly deviating from our Indian IPOs. Institute has probably taken the same thing as it is without even bothering to complete the sentence, without even bothering to whether it is valid in India or not. Because every time they have written SEC and every time I have added SEBI also from my side. So some steps which are mentioned here may not be applicable as it is in India, like the 20 days period, maybe 30 days in India. During the period after the filing, SEC or SEBI examines the registration statement and engages in a series of communication with issuers' counsel regarding any changes necessary to bring about. Okay. So once you file the offer document with SEBI, they will see whether any modification is required. If the changes are minor, they are included in the price amendment. In USA this happens. If the changes are extensive, a new prospectus is prepared and distributed. So either they will issue one amendment note or they will issue one new prospectus altogether if the changes are major. But in India it does not happen like that. First the SEBI has to say what is to be modified. After doing that modification, then we release the prospectus. So the question of issuing a second prospectus in India is not there. This is what I have understood from my limited knowledge on Indian issue of prospectus. First to get all your problem resolved at SEBI's level only, and then you come out with an. But here they mentioned that you will have to issue a revised prospectus if SEBI asks you or SEC asks you major amendment. Anyway, last 2-3 paragraphs, be careful. According to the exam question, you answer. Now we have seen IPO nowadays is a game of marketing, creating an image. What is marketing? Creating a perception, okay, that this is good, this is very good, buy this, it will help you. So similarly, IPOs means you have to convince the investor that this stock is going to be the next Facebook, the next Microsoft. You have to convince them, create a perception. Then more and more investor will come. You will not know, there are some IPOs have got such a big hype that within 10 to 15 minutes on the first day, when the IPO opens, it is oversubscribed. It is oversubscribed. That is marketing. That is the power of marketing. Like I remember Reliance Power, okay. I was sitting in a dentist cabin, lying in that stretcher kind of thing, whatever is that. No, I had a lot of pain after teaching for 11 hours on a given day. And that fellow said, "Sir, please wait." I said, "What happened?" "I have to sign that application form because today the Reliance Power issue has opened, and if I don't sign and give it to my broker, maybe I will not get the subscription." Are bhai, I said, "I am in pain, please help me." He said, "Sir, please wait, I will lose the application. You can go to another dentist. You will give me some 1,000 rupees and I will earn 2 lakh rupees if I get the allotment." Somebody had told him that this amount will double in next 4 months.
You must have said him, invest in ASF, you will get more than that.
Okay. This is the height they created. And the price of Reliance Power is now 80% down. I think 90% compared to the IPO listing price. Tata Timken, you may not have heard this company, it's an old story now, more than 15 to 18 years, 55 times oversubscription, 55 times. So what they did, they kept the money in an account where they could earn interest, and that time you had to refund the amount within say 45 days or something, oversubscription. They earned so much interest that they said we can now refund the entire amount and we don't need the public money only. Yes or no? That is the marketing. But I don't know, but they had to issue the shares. Once the approval, the third phase is marketing. Once the approval comes on the prospectus, the company embarks on a road show to sell the daily. What is road show? We'll discuss, very important. This term you will hear in lot of media, finance news channels. This company is going for a road show. Road show is nothing but you are telling your investor that you have to invest in this IPO. So you meet the investor, big investor, give them presentation about the company, and then try to convince them why this company is worth investing. Nowadays, because there are ADRs, GDR also issued, they do roadshow in different countries also. So from where people can invest. So a roadshow involves meeting potential institutional investor interested in buying shares in the offering. So you invite all the big investors. So you will keep a conference type of thing in a big hotel, 7-star hotel, and give them all the best possible facilities, amenities, and convince them. So typical road shows last for from 2 to 3 weeks because you have to visit different cities. Okay, they go to Mumbai, they go to Delhi, Kolkata, Chennai, Bangalore, Pune. Okay, they invite the investor, they invite all the big brokers in Pune and involve meeting numerous investors who listen to the company's presentation and then ask the scrutinizing questions also. So investor can ask question also. When is your power plant getting ready? He will say after 10 years. Then why you are asking money now? Okay, you should first make it run and then we'll come to you. This way they ask the questions. Don't you think your technology will change after 3 years and your company would suffer loss? Then the management has to reply to that. Okay. Don't you think regulation will change in India after 2 years or 3 years and then this product will not be sold? So all these questions, you have to be ready with the answer. Okay. Often money managers decide whether or not to invest thousands of rupees in a company within just a few minutes of presentation. So if you give a powerful presentation, convincing presentation, you will be able to convince these money managers, that is those who manage the funds of these institutions, to invest in your company. So that is why they carry those people in the conference who can speak really well in that conference. Is it right? So have you ever seen, who is that person? Steve Jobs. When they have to launch the product, iPhone, amazing presentation in front of thousands of people and which is live telecasted. Nowadays that Elon Musk who gives the presentation. So it convinces the people in 15 minutes, oh yeah, this is the company to be in. And then registration and marketing process can take several months. And it is therefore impossible for the underwriter to include certain information such as final IPO price, the price discount, precise discount to the dealer, and the names of all the syndicate members in its initial filing with the SEBI or SEC. So some information may not be given at the beginning to the regulator, which in USA is SEC. On the day prior to effective date, after the market closes, the firm and the lead underwriter meet to discuss the two final and very important details. So what are the two final important details? What will be the offer price? And how many shares are to be sold? This is a crucial decision because number of shares sold will affect your percentage holding in the company. After those final terms are negotiated, the underwriter and the issuer execute the underwriting agreement. The final prospectus is printed and the underwriter files a price amendment on the morning of the chosen effective date. This procedure is more common in USA. Once approved, the distribution of the stock begins. Now suppose you have received the application, you will allot the share. Then once allotment etc. is done, the company stocks open for trade for the first time. So this is the first day of trading. The closing of the transaction occurs 3 days later when the company delivers its stock and the underwriter deposits the net proceed from the IPO into the firm's bank account. But the IPO is far from being complete. Some story still left. Many times these underwriters or the investment bankers have to do some post management also, post IPO management also, because the prices may be very volatile. So like we have learnt about green shoe option, okay, post price stabilizing mechanism, they have to perform that also. Once the issue is brought to the market, the underwriter has several additional activities. These include, underline, after market stabilization. We will not discuss green shoe option again today. That means they will either buy or sell additional shares in the market. They will buy or sell additional shares in the market, and therefore they will try to bring price stability. This includes after market stabilization, the provision of analyst recommendations, and making a market in the stock. Making a market in the stock means they will create demand and supply. If there is too much of demand, they will create supply, because they will borrow shares from the promoter and they will offload it into the market. If there is too much of supply, they will become the net buyer, they will buy the stock. The stabilization activities essentially require the underwriter to support the stock by buying shares if order imbalances arise. That means they will buy or sell shares to bring the prices at a stable level. Understood? Now you write there, refer green shoe option, which we have covered. Green shoe option we have covered. The price support can be done only at or below the offering price, and it is limited to a relatively short period of time after the stock has been trading. In green shoe option, do you remember what is that period of time for which you can perform the market stabilization activity? 1 month. 1 month, 30 days only. This whole green shoe option is available only for 30 days from the date of listing. Within 30 days only you have to do. After that, let the market decide. In general, the underwriter will continue to actively trade the stock in the months and years following the offering. Afterwards, you will buy, sell as usual. By making a market in the stock, the underwriter essentially guarantees liquidity to the investor, and thus again enhances demand for the shares. Same thing they are repeating again and again. They could have simply said refer green shoe option for post-market price stabilization. Right? So what they have described in the last few sentences is green shoe option. A company that is already publicly traded will sometimes sell stock to the public again. What do you call this phenomenon? It is called follow-on offering at the top. It is called, or secondary offering of the stock. In India we call it follow-on public offer. Okay, in some countries they call secondary offering of stock. Why will a company go for follow-on offer? More money. Is it right? More money they require. Expansion of their company's business. So question for you, what are the reasons for follow-on offering? Huh? Regulation.
Companies like banking may require for tier 1.
One reason is to raise funds for financing their growth, financing their expansion. Second point, what you said, in case they need to maintain a certain amount of capital adequacy ratio, like in case of banks. Okay, so I will add that also. In case of, like in India, we are going to have lot of banks capital getting increased now. In recently, one news article said government is going to infuse 80,000 crore rupees as capital into the banks. 80,000 crore rupees. In case of bank NBFCs, right, this is a good point. In case of bank NBFC, they need to maintain CAR, capital adequacy ratio, which under Basel III is more stricter. So more and more banks, NBFCs will raise capital through follow-on public offer. Okay. Point number 2 on the screen. In your book this is written. Another reason that a company would issue a follow-on offer is similar to cashing out scenario in the IPO. Suppose you feel that your share prices are very high What do? Take advantage. Issue share, raise more money. And when the prices will go down, after some time, buy back. But of course, there must be a gap of 1 year, as you have learnt in Companies Act. No buyback can take place of the same kind of share within 12 months or within the same financial year. Otherwise, you will start trading in your own stock only. But again, management is smart. They will normally issue, if the prices are very high, raise more cash, and later on you can use that cash to again buy back and make some income out of it. Subject to the four corners of the law. Because for buyback, not only the Companies Act is applicable, SEBI guideline is also applicable. And then I think Income Tax Act also has recognized this. Companies are going to make profit in this process. Just check your Income Tax Act, they will charge you some income tax also on that. Clause in 3CB. What is that? Tax audit report. 3CB. Okay, I'll check. I only sign wherever my consultant says, okay, you sign here, I will file it. Huh? So you don't sign now. So what then he asked me to sign every year? It's financials he asked me to sign, the balance sheet. Okay, I thought that is what you file with the government. 3CB. Okay. I have never seen, only last 2-3 years. Where a company requires capital, issue of debt now. Issue of debt is simple exercise, less exciting. Okay. But still you raise a lot of money through debt. Why would company issue debt? Question. First we will see, one reason could be you will not be able to issue equity share. Either you are not fitting into the legal compliances, market is subdued, there are not many equity investors, you are a very new company and therefore investor will not show interest in buying the equity share of your company. So even though many times we may have a desire to bring equity issue, but legally and practically and valuation wise we are not able to do that. Okay. So therefore we will go with debt. Generally which company comes out with a debt offer? Those which is already listed. You will not find debenture of an unlisted company floating in the market. Most of the debenture that you see has been issued is only by the listed company. So the process is similar. The process of issuing debenture and bond is similar to equity. The only difference is the focus of the prospectus. In case of equity, what is your focus? That you will focus on growth, expansion, okay, capital appreciation, earnings. But in case of issue of bond, your prospectus would focus on the fact that company is going to generate stable income, stable cash flow. Don't worry, you are going to get your interest and principal on time. So this may not be as aggressive as equity issue. Equity issue is very aggressive. Okay. Reasons for issuing bond. This I have covered in your bond valuation chapter also in group 1. Reason for issuing bond, first is the stock price of the issuer is down. Market is not good. Okay. So instead of issuing shares at a low price, it is better to issue bonds. But the reasons why in India company issue bonds and debenture is point number B. They don't want to dilute the control. They don't want to dilute the control. Control is important so that you can run the business according to your ideas, your wishes. You don't want interference. Sometimes in the economic downturn, investors' appetite for public offering dwindles to the point that where an equity deal just could not get done. I have seen some companies in a falling market, they announced the IPO, they had filed the basic documents with SEBI also, they had filed the red herring prospectus also, and then on the last day or few days before, they have withdrawn. Why? Because they were not sure whether I will get that minimum subscription or not, and it causes a bad will to the company, that this company could not raise 50% of the offer price also. So unnecessarily they will not do that, because company's reputation is affected. Your history will always follow you. Remember, so what you are doing right now will also become your history in future. Is it right? And one day after 20 years, what you have done in the past will come to you, and it may affect you in good or bad way. So after 10 years, if you want to again issue, now the investor will think, oh, this is the same company which had withdrawn the application. I will not invest. Is it right? So reputation is very important in business. Goodwill is very important. Now importance of the bonds credit rating. Very interesting, okay. In India and in many countries, if you are going to raise money through bonds and debenture, there is a legal compliance. What is that? Rating. You have to obtain the credit rating from a reputed, independent credit rating company. Now this reputed and independent is very important. But it has been observed, not to be mentioned in the exam, that many times this credit rating is not impartial. They are influenced by the managers. The reason is they get the fees also from the same company. So advantage of credit rating is that if you get a good credit rating, it becomes easy to market your product. You can convince the investor that, see, we have a AAA rating given by CRISIL, so invest, don't worry. You can negotiate a lower rate of interest also. Okay. So that is why these managers, companies managers, they are after the credit rating company. Please give me good rating. Just like in your office, in big companies, the management is always running after the auditor. Sir, please do not qualify. Sir, please do not qualify. Have you seen such situation? I have seen when I was working in AF Ferguson. Okay, the moment if there is something to qualify, then the whole team, manager, shareholder, or the promoters, chairman, they will come on their knees and they say, sir, please don't qualify, because our banks will object and then will not get further funding. So we'll take a small 30 seconds break.